Here's a question most investors can't answer. Your mutual fund made 14% last year. Is that a good number or a lucky number? You can't tell until you know one more thing: how much that fund's returns actually swing around year to year. That's what today's video is about. Most of us were taught to think about risk in words: high risk, medium risk, low risk. A distributor says a fund is aggressive. A friend says stocks are risky. But here's the problem. What feels risky to you might feel perfectly comfortable to someone else. Vague words can't be compared, can't be measured, and honestly, can't really be trusted. If risk is going to guide a real decision with real money, it needs a number, not an adjective. That number is called standard deviation. And once you understand it, you'll never look at a returns chart the same way again. Let's start with a plain English definition. Standard deviation is a statistical measure of how much returns swing around their average, used here as the primary measure of a portfolio's risk. That's the textbook line. Now let's actually unpack what it's doing for you. Step 1. Every investment has an average return, and an average hides a lot. Say a fund has delivered 14% per year on average over the last several years. That single number feels clean and reassuring. But an average is just a midpoint. It doesn't tell you whether the fund quietly gave you 14% every single year, or whether it gave you 30% one year and -2% the next, and still averaged out to 14%. Two funds can have the identical average return and completely different experiences for the investor holding them. That's the gap standard deviation exists to close. Step 2. Standard deviation tells you the spread around that average. Once you know the average return, standard deviation tells you how far returns typically stray from it, in either direction, up or down. A low standard deviation means the returns tend to cluster close to the average, year after year. A high standard deviation means the returns swing widely. Some great years, some poor ones, even if the long-term average looks similar to a steadier fund. Step 3. This is why same average, different experience matters in real life. Imagine two funds, both averaging 14% a year over time. Fund A has a low standard deviation. It tends to deliver return somewhere in a narrow band most years. Fund B has a high standard deviation. Some years it might do 28%. Other years it might do flat or negative before evening out. On paper, in a long-term chart, both look like 14% funds. But if you're the investor living through Fund B's bad years in real time, not knowing whether this is the down year or the up year, that experience is far more stressful and far more likely to make you exit at exactly the wrong moment. Standard deviation is what lets you see that difference before you commit money, not after. Step 4. How to actually read the number. Here's the practical part. If a portfolio has an average expected return of say 14% and a standard deviation of 6%, a simple way to think about the likely range is 14% plus or -6%, meaning returns in a typical year could reasonably fall anywhere between roughly 8% and 20%. The lower that standard deviation number for a similar average return, the tighter that range and the smoother the ride. Step 5. Why this beats high risk, low risk as a label. Once you have this number for a portfolio, you're no longer relying on someone's opinion of what counts as risky. You can actually compare two funds, two portfolios, or a stock portfolio versus a mutual fund portfolio, side by side, using the same yardstick. It turns a subjective conversation into a factual one. Here's the analogy that makes this click. Think about your daily commute to work. On average, it takes you 30 minutes. That's your average return. Now, does it always take exactly 30 minutes? No. Some days traffic is light, some days there's a jam. Let's say your commute has a standard deviation of 6 minutes. That means most days, you can expect to reach somewhere between 24 and 36 minutes, 30 minus 6 to 30 plus 6. That's a fairly predictable commute. But imagine a friend whose average commute is also 30 minutes, but his standard deviation is 15 minutes. Some days he reaches in 15 minutes, Other days it takes 45. Same average commute time. Completely different day-to-day experience. That's exactly what standard deviation captures for a portfolio's returns. Not just what you'll average out to eventually, but how bumpy or smooth the actual ride will feel getting there. The next time someone tells you a fund's average return, ask the second question. What's its standard deviation? Two investments with the same average return can feel completely different to hold. And now you know why and how to check. That's standard deviation, explained without a single textbook formula. If this helped, the next video in this series builds on it directly, looking at what risk-adjusted return really means and why 15% return isn't automatically better than a 12% one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.